Hello, everybody. This is Chuck Carnevale, co-founder of FastGraphs, the fundamentals analyzer software tool, aka Mr. Valuation, bringing you another Lessons in Valuation subscriber request series 2-minute drill on Alphabet, aka Google. And this is actually Google L, which I'm looking at here. Now, the thing about FastGraphs are that they give you a quick look at the business behind the stock. And as we can see, Google, or Alphabet, has been a really excellent business. This is going back to 2005. They've grown operating earnings at over 28% a year. Okay, and we're using the P equals growth rate formula that Peter Lynch made famous for growth this high. So that's a PE ratio of 28. So when I put weekly closing stock prices on the graph, you can see how the prices followed that growth rate almost perfectly. But here's what you want to be aware of. As I shorten the time frame, Google's growth rate slowed down precipitously from over 28 to 18. If I shorten the graph again, now we see a little surge coming up in growth. But looking forward, we only see 11% growth expected for this year. Remember, and we're looking at 14% growth for the following year and 15% after that. All right, so Google is slowing down, but it looks undervalued from this perspective. But if I go into the forecasting calculators and look at Google expected to grow at 13% a year, that would indicate a 15 PE as being attractive. But it's not necessarily massively overvalued here, but it's not, in my view, a real cheap stock at this point. If I look at the normal multiple that the market's applied, that gives us, for the last 5 years at least, that gives us a PE ratio of 25, okay? And that's what it's historically traded at, as I showed in the historical graph. But things are changing and growth is slowing down. But regardless, this is a great company. It's AA rated, has less than 7% debt. It offers a very modest yield, dividend yield, that they just started paying, as you can see here, by the dividend stacked on top of earnings in the white line here. So the stock is one that you'd want to do your more comprehensive research and due diligence on. And remember, FastGraphs gives you the ability to look at several metrics, including things like EBITDA growth. But they also give you the opportunity to go into fiscal fitness and look at things like free cash flow higher than dividends. You can look at margins and a lot of things. So the FastGraph tool is very, very flexible in terms of how you can analyze a stock. But Google is a great company. It's trading at a much better valuation now than it has even more recently. And again, as I shorten the time frame, I want you to understand that this is a $2.04 trillion company. Anyway, here's a quick look at Alphabet or Google. If you like the video, give me a like, subscribe to our YouTube channel, and also take a look at FastGraphs, the value investor's best friend. Thanks for watching.